Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the alternative labor data he's looking at as he looks at mortgage rates and also about foreclosures. First, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, and we all made it. We all survived the repo market scare of November of 2025. You know, I love all my fans, but my God, everyone sent me that guy's video about the repo market run on the banks, 1929, whatever. Oh, Lord, that's just not how it operates. Just remember, people, because social media gives people the ability to talk and say something, and, you know, BlackRock is buying all the homes, or there's a foreclosure crisis, 5 years ago, whatever it is. These people are not trained to talk about it. The repo market went back to normal this week, right? There's no stressful thing. The Fed didn't have to come in or do anything. Even Beth Hammack, the Cleveland Fed president, who I'm not the biggest fan of, basically said, yeah, we expect some volatility in the marketplace, but I thought it'd be a lot more, so be careful of the repo story, because it's one of these things that not a lot of people know about. It's very hard to explain, and it's not a run on a banks or the banking system is about to break. It literally just went back to normal this week. So be mindful of that in the future.
If people listen to this podcast, they'll know. You would tell people if there was something huge going on like that. You're watching stuff all the time, more than anyone I know, really. Let's be honest. You are on top of all of this. So if there was a problem, you would let us know right away.
The Federal Reserve can fix that like this. Like, remember the Silicon Valley banking crisis, and people thought, yes, that's it. Federal Reserve over the weekend went like this, right? And that's one of the reasons why we have a Federal Reserve, is that they can do things to keep expansions going and keep recessions very limited. The people that hate the Federal Reserve are people that, if we could just get a time machine and send them all back to 1760 to 1900, and how inflationary and deflationary those economic cycles were, and banking crisis and everything, they would love it there, because, all that doom, in the banking system, they would go, oh, this is wonderful. This is my slice of heaven. But now in modern times, things have changed. So this is one of the benefits of having a Federal Reserve banks. If they have purposely drove down their quantitative, they've done QT, they've reduced their balance sheets, they've raised rates, all these things that a lot of people have said the Federal Reserve can never do, because the U.S. will go into recession, stocks will crash, and everything. This group, one group of people, like if you get the anti-central bank people and the MMT people, and you get Stephen King and Ray Dalio and all these doomers put together, you can really make a fun character. It'd be like Lord Byron, the old poet, and Godfrey, the Game of Thrones child king. Mix them together, you get some crazy delusional person. But in this case, it wasn't ever an issue, because if it ever became a liquidity problem, the Fed could come in, buy assets. That's it. End of story. Don't worry about this one. There are other things to worry about than this.
Okay, well, let's talk. So we're recording this on Thursday, but this will come out on Friday. So a very unusual week. We are in now. We've surpassed all the other shutdowns. So this is the longest government shutdown, which means we don't have government jobs data. We also had a pretty big election, lots of local things, but probably the biggest is that, Mamdani won the mayor of New York City, which has, thrown people into some, depending on where they are, they have big feelings about it. And then you also have the Supreme Court looking at whether Trump's tariffs can stand. So huge week on a lot of fronts, but what we don't have is the government data.
But we have enough jobs data where the bond market does move off of it. So This is a very, very interesting week. I could care less about any election. What the Supreme Court does to Trump's tariffs is one thing. But what happened yesterday was the ADP report, which we're reduced to the ADP report. That's a sad thing. The ADP report showed that 42,000 jobs were being created. As much as that hurts me to say that in the Federal Reserve's eyes is, hey, it's not getting worse. So now it's Thursday morning, and what happened? Because we don't have the government data, we're running on these secondary data lines from private companies. The Challenger jobs data, which it showed a large level of firings or cuts being announced. That not that important in general terms to the marketplace, but we don't have any other government data. We'd have jobless claims right now. We'd have jobs week. We'd have a bunch of things to work off of. However, what I've noticed is that a lot of people are going to secondary labor companies like an ADP Verge. It's called Revlion. And that was showing a little bit of job growth the last 3 months. And the last month was 54,000. Now, 54,000 isn't a lot, but in Fed terms, that's perfectly fine. You know, that data line went negative today. You know, it's jobs week, so we would have all this data. That, I believe, threw the 10-year yield down lower. So I made a joke today, 10-year yield went down lower. Why? It wasn't the tariffs or wasn't anything else. It's the labor data that we have to work with. Thank you for your attention on this matter, out there. So we're having very wild moves now off of data lines that we don't usually weight too much, but because there's no data out there, this is what it is. And bond traders just got very fidgety this week. But again, same premise as always. The only reason the 10-year yield is at 4.08% right now, this morning, Thursday morning, is that the labor data was getting softer. And because it's getting softer, the Fed still believes in being modestly restrictive, right? They're still saying this. You're very prone to shocks at this stage because any little thing can accelerate the firing levels, which makes things worse. When you're working from 250,000 to 300 jobs a month, you got a lot of leeway. But now you're just here. So I say this with all honesty. I hope all the football fans get this. Jerome Powell is playing himself out of the Hall of Fame. It's like Russell Wilson, quarterback of the Giants, right? Russell Wilson, I'm a Niner fan, so I got to see him do crazy stuff against the Niners all the times, but he's been terrible the last few years. He should have just retired 3 years ago. Jerome Powell should have just let this whole thing of his go away because he's now moving into himself a very precarious position right before he leaves the Federal Reserve. There's no reason to be modestly restrictive. You could just slowly move the forward guidance to neutral. That's it. Neutral policy so you don't have these volatilities off of the labor data that people are getting confused about. So very interesting week on that front. Even though we didn't have jobs week, we're having volatility off secondary, third, private sector data lines. And it's just like people are just fidgety. But keep it very simple. We're only here because job growth has slowed down. We have sectors of the economy that are losing jobs. And the Fed keeps on saying, we're modestly restrictive. It's okay. But thankfully, there's a civil war out there. It's like Iron Man versus Captain America.
A civil war within the Fed.
Yeah, with a Fed, just like, people that says, I think Daly, when she said it, I don't want to wait until the labor market breaks to play catch up. Beth Hammock would say, we can play catch up when the labor market breaks, so there is a conflicting view out here. My thing is that if you're modestly restrictive, you can have forward guidance get a little bit easier and not risk anything out in this sense. So it's one of these things that unfortunately we're here, but thankfully the bond market has done a lot of the heavy lifting for the Fed and has not stayed modestly restrictive at a higher level for a longer period this year because things could have been a little bit different. But even though we didn't have jobs week, the jobs data really did play a role in the volatility of the bond market. So mortgage rates fell 8 basis points lower today. On that, we're not that far from year-to-date lows on mortgage rates. They can just guide this lower because when Beth Hammock says there's no demand destruction out there, I always laugh because everyone says there's no jobs being lost. And I show the manufacturing charts being lost. I show construction jobs being economic cycles. That's not a very good thing when you have both. You just guide a little bit lower. You're not cutting interest rates to zero. You're not doing anything. There's no point in being like that at this stage. And unfortunately enough, they were forced to be a little bit more dovish because they did not want to do this. And I think it's a positive thing that the 10-year yield and mortgage rates are down here. So we wouldn't have to deal with a 7.25 or 7.5, where things could get even worse on that side. And the capital investments, the things that need lower rates to get it going. The AI boom doesn't need lower rates whatsoever. There's so much money being poured in. It didn't matter if Fed funds rate is at 7%, they're going to do it. But there are sectors of the economy that do have weakness that are rate related. If you're worried about the labor market, you could treat it a little bit differently. But again, my thing has always been they want to see labor weakness. They attack the labor supply. They've talked about it. They need wage growth to go lower. But the main thing since 2022 that they were going to be as restrictive as possible until the labor market breaks, and that's jobless claims. And when jobless claims start to hit higher, anything they say doesn't matter because the market will force them to play catch up.
So how do you weight those secondary job reports, like the alternative data that everyone's looking at now? How do you weigh those and judge those?
So we look at it in this light. There is the Indeed job openings data. There's the state jobless claims. ADP and BLS do trend together. They're not exacts. There are a lot of times they're going to be off a lot, but they do trend together. So it's been here for 12 months, right? The labor market was getting softer last year, but it wasn't breaking. Then it took another stage softer. So again, we just don't have a lot of leeway. And to me, you're more susceptible to any kind of shocks, right? We have a lot of consumer related companies that are missing earnings, that are more related to people's income brackets that are lower and kind of maybe the low end of the middle class. And Barr of the Federal Reserve, one of the Fed presidents, says, well, it looks like a two-tier economy. Looks like the wealthy are doing great. The wealthy are always doing great, man. Come on. But, why don't they address the lower income? Why don't they address the credit stress of the lower income? And what we've always said here, Sarah, for years, they don't care. There has to be pawns and sacrifices in every economic cycle, and this is it, right? They're just going to say, okay, we don't see that as being a big macro issue yet. But it all falls back to one data line is jobless claims. If jobless claims breaks, there's not a lot of good history of jobless claims breaking and then just coming right back down. So you have to find your level of where jobless claims is actually breaking. Mine is 323,000 on the 4-week moving average. I think last time we were like 230, but based on the old data. So it's just one of these things we're dealing with. But thankfully, the bond market did the right thing. The bond market was correct here. They took yields lower, not because of inflation, not because of treasury supply, not because the labor data was getting softer. And every year in the past few years, whenever there's a growth scare, money goes into bonds, into the mother bond market, which is the Godzilla and King Kong on steroids versus all the other countries in the world. Safety.
So it's interesting that you were talking about like a two-tier economy. To your point, I mean that's kind of the way it always is, right? Like rich people are the ones who spend the money. But I've been at several conferences over the last couple of weeks, and one of the things that they talked about was that you do have like the baby boomers specifically, and maybe Gen X doing a lot more spending than younger people. What is your feeling about that?
Well, generally, the Federal Reserve actually addressed this question. Jerome Powell says lower income people are more prone to spend more than usual when the economy is expanding because rich people always spend a certain amount all the time. So they have a lot of wealth that they basically hoard. They're not spending that. So lower income people tend to spend more when their wages rise because they make more money. I would say this. Older Americans spend money differently than younger Americans. So what do we always say with economics, right? Your lifeline to your economy is younger people. Why? Because they rent, they date, they get married, they have sex, they buy homes, right? They buy more stuff for their homes, and their wages grow throughout time. So when you're in the Gen X or the baby boomers, if you're still working, you're in the upper income bracket of your career, where the younger people are just household formations, but they spend more on other stuff than, let's say, a baby boomer. Baby boomer is not necessarily buying a new house and, rooms for their kids or anything, but they spend more on service, Carnival cruises, stuff like that out there, where a younger household tends to buy a little bit more big ticket items because they're creating, a life. You buy single family homes, you buy more stuff for it. That's how economics works. So a country that has a good replacement workforce is a positive. This is why the US has like a demographic edge against other countries. Like China doesn't have this. Japan, we've always said, sells more adult diapers than baby diapers, and 40% of their population will be dead by the end of the century. Europe doesn't have this. But the US, with millennials and Gen Z and Gen A, they have a good enough replacement, right? It's not like a massive growing population, but they have a good enough replacement. And immigration data has slowed down a lot, but immigration in our younger workforce has has really bolstered the US for the last 200 years, because the people that immigrate here, they have families, their kids have families, younger workforce consumers. That's been our strength as a country in the past 200 years.
Okay, related to some of the like what data we should be paying attention to, what we don't need to worry about. Let's talk about foreclosure data because
Yes,
that has come up quite a bit lately.
yes. Every quarter, the New York Fed comes out with its household debt uh, um, data lines, and of course, the doomers always go, "Oh my God, we have $18 trillion of debt or 20 trillion or whatever it is," but they never talk about the balance sheets, right? Like we have $200 trillion of financial assets versus like $20 trillion of debt, whatever. If you add it out, the people that have the majority of the debt in this country are homeowners, and homeowners have a disproportionately higher income, higher financial assets, so they're the wealthiest group of civilians we've ever seen in the history of the world. I always say I can maybe make a case that Cleopatra had enough wealth as America did, adjusting to inflation. But outside of her, our homeowners are doing great. But we also have a group of people that have constantly talked about the forbearance crash bros, the foreclosure crisis that has been here supposedly for 10 years. And it's our chart, right? I always tell people, when I die, Sarah Wheeler is going to make sure that it says Chart Daddy on my tombstone. And then you're going to put that one chart up there. And what it's consistently showed is that the foreclosure crisis in 2008, and you could always explain this. If anybody wants to explain it in this front. We've had many recessions post World War II. We've had many recessions where the credit data looks worse, but we've only had one foreclosure crisis. So why is the time where homeowners on paper have never looked better? Why is this the worse than 2008 or 2008 recession, right? The educated class reads. When we always talk about the devil and the devil's whispers in the ears of people who don't know, they try to manipulate. But here we show these charts and go, the 2008 housing crisis, credit was breaking in 2005, 6, 7, and 8. Then the job loss recession happened. It was underwater mortgages. New listings data was running at 250 to 4. There's all these things that happened. After the 2005 bankruptcy reform laws in 2010, a lot of that leveraged credit debt was taken away from consumers. So they can't do it like they had. Now, people go, well, the FHA. So the trick on the FHA is they show the delinquencies rising. They never show the delinquency charts going back to the start of the century. FHA has always had a higher percentage of delinquencies, and we've had tons of recessions, and there's no foreclosure crisis. There's what we call as late cycle lending, where people with the lowest down payments are already underwater in a sense that they have a solar panel loan or reconstruction. Those people are at risk for a foreclosure, but that doesn't necessarily mean a foreclosure crisis. So it took 4 years for the housing bubble foreclosure crisis to build itself up in a very high velocity credit market. Don't have that here. It's November 2025. It's almost Thanksgiving.
Right.
It's like, and the foreclosure data ticked up a little bit. If anything, I got my foreclosure forecast wrong in terms of I thought we'd already be back to 2019 levels. So when a job loss recession happens and jobless claims start to rise, there's going to be an increase in delinquencies. Happens all the time, but it doesn't necessarily mean this protracted big crisis event. I always show people the 2000 data, the 2001 recession after the tech bubble bursted. Nothing happened. We had some unemployment rate went up, some foreclosures, rates went lower, housing demand picked up, didn't really even go down during the recession. So be careful out there. And this is why we always highlight this, because I see it all the time. People say me, oh my God, it's foreclosure. Oh my God, the ARMs. We're still living off of old posts of people saying the 2019 ARM loans are going to crash the market in 2024 and 2020. It's like, homie, it already expired. You got to pick something else. So
I would say to all of our audience, go read Logan's article on this because I thought you did a really good job outlining exactly what you said. Is like, we've had all these recessions. Why haven't we had a foreclosure crisis again outside of 2008? And you really break it down. Like, the things that have to be in place that were just very specific to that time are not happening now. So even if you had a couple of those things happen, maybe they'd tick up a little bit. You would have to have so much, like the fact that 40% of homeowners don't even have a mortgage, or the fact that they have so much home equity, or the fact that they wouldn't be selling into this market where there were 300 and 400,000 new listings every week for years on end. So it's just so specific to 2008.
When we see a crisis, we'll see it in our new listings, but we'll also see it in the credit data. And it's November. Remember the forbearance crash bros?
Oh,
Remember that whole
yes.
group that just wouldn't let it go? And I said to myself, you know, these men, it's always guys. Oh, there's some crazy ladies out there, but there's always these guys who are you could just tell that these are not the intellects of our society. But one of the things that happened is in October of 2020, anybody who made $60,000 or more already got their jobs back. And a lot of these people had low mortgage rates. Like, why would you purposely lose your home if you're employed? And they
Right.
didn't care. They're like, oh, forbearance is going to do. It's like, no, forbearance ended. It's already ended. It's going to take a long time for the data to like wind itself off, but it's already over. Right? You see this nominal number, and people are saying it's going to go to 10 to 15 million. It was 5 million. I said, nope, it's going to be going down. It got even when it got to 0.5%, people were still doing, oh, forbearance is going to happen and everything. And we have to do this, Wheeler. The devil just whispers in these men's ears and they can't let it go. And I'm telling you, as God's righteous man, my job as an economic priest or economic witcher.
Oh, wow.
Oh, yeah, this is good. One of those two, we have to go out there and fight these monsters and teach people, right? If you teach and educate a society, it's the worst thing for fanatics. And this is going back 2,000 years, man. This is not anything new. So the
Okay,
conflict
well,
has to happen.
I did see an embroidered pillow at Home Goods that made me think of you, Logan, and is relevant to this. It says, "The higher the hair, the closer to God." So
Oh,
there you
yeah,
go.
there we go.
And there you go.
There's
You're
nobody going to have higher hair than this. And I could just, do a lot of stuff with this one. So
this isn't this is probably meant to talk to Dallas women. Dallas women tend to have big hair, but like they haven't met you. So I was like, okay, I've got to buy you that pillow because it made me laugh.
very well said, Sarah Wheeler.
Very well said. Okay, well, we'll end on that note. Okay, higher the hair, the closer to God. Thank you so much for being on, and I love it because here's the thing: we'll see it in the data. You'll talk about in the data. There's no reason to panic about stuff that's just not even true. So I think that that's the thing that I always take away because I go to a lot of conferences where hear a lot of different viewpoints, and there are people who look at different data or similar data, but they interpret it in a different way, and it's like I love to always pick your brain about these things.
I'm telling you, if you are bringing people that have been bearish on America for the last 4 years, you are doing a disservice to your audience because obviously their models is not working. I get it. I get it why doom porn sells. People will tell me, hey, listen, I'm just doing this because I'm trying to earn money. I don't care. You chose the unrighteous path. And our job is to be the shepherds of data out here. So yeah, that's my job.
Well, you do it well. Okay, Logan, we will talk again soon. Thank you so much.